Question 9, Lamri. So this question mainly focuses on two things. One is dividend capacity and the other one is transfer pricing, right? So under this transfer pricing, you should know what are the ways of calculating transfer pricing and also how to prevent the transfer price manipulation, right? And also this is the last question under our first section, role of senior financial, right, manager. So before this, let's go to the requirements. Okay, so the requirement is calculate the Lumbri's dividend capacity for the coming year prior to implementing TE's proposal and after implementing the proposal. So first you have to, before implementing and also after implementing the proposal, right? You have to calculate the Lumbri's dividend capacity. Next, comment on the impact of implementing the proposal and suggest possible actions Lamri may take as a result. So first you have to impact of implementing the proposal and also possible actions. Third, outline the mechanisms that the tax authorities could use to prevent transfer price manipulation by Lamri, right? So the mechanisms to prevent transfer pricing manipulation. Now let's go to the requirements. So Lumber is a listed company and is expecting sales revenue to grow to 80 million next year, which is an increase of 20% from the current year. 80 million is sales revenue, which is an increase of 20% from the current year. When you read this sentence, please, most of you will think that we have to increase by 20%, right? 80 by 20%. No. Read this sentence again. Is expected sales revenue to grow to 80. 280, not by 80 or something. 280 million next year, which is an increase of 20% from the current year. That means currently, right? For the next year, sales revenue is 80 million. That means the reason sales revenue is 80 million. It has been already calculated with 20% increase, right? So that 20%, they have already increased it by 20%. They just wanted to tell that from the past year to the current year, the increase is 20%, right? So now it is 80 million. You're not going to increase this 80 million by 20% again. Operating profit margin for the next year is forecast to be the same as this year at 30% of sales revenue. So 30% of sales revenue is the operating profit margin. In addition to the profits, Lamre receives 75% of the after-tax profits from one of its wholly owned foreign subsidiaries. Lamri has two subsidiaries in this question, right? So from one of the subsidiaries, he's receiving the dividend, and from the other, he's not receiving dividend at all, right? So he's receiving 75% of profit after tax from Magnolia as dividends. However, its second wholly owned foreign subsidiary, Strymon, does not pay dividends, right? So Lamri is due to pay a dividend of 7.5 million shortly and has maintained a steady 8% annual growth rate in dividends over the past few years. So dividend is 8.5% and the growth is 8% annual growth, right? The company has grown rapidly in the last few years as a result of investment in key projects and is likely to continue. Now, for the coming year, it is expected that Lamri will require the following capital investment, right? These are your areas where you need to focus on because you have to start your calculations from this point, right? Wherever you need for calculations and all, you have to pay, you have to be very critical, right? When you read also, read it twice or thrice, it's okay, but read it until you understand it properly. Just reading once, you might not understand, right? So an investment equivalent to the amount of depreciation to keep its non-current asset base at the present productive capacity, right? Lumri charges 25% on a straight line basis on its non-current assets of 15 million. So depreciation is 25%. Okay. Straight line basis on 15 million. This charge has been included when calculating the operating profit amount. A 25%. Okay, so the twist is here in this part. Okay, just wait and watch. A 25% investment in additional non-current assets for every $1 increase in sales revenue. 25% investment in additional non-current asset. And it is also for one increase in sales revenue. And 4.5 million additional investment in non-current assets for a new project. 4.5 million additional investment. Now, Lamri also invests a 15% investment in working capital for every $1 increase in sales revenue. So 15% in working capital for 1% increase in sales revenue. We need to work out all this. Strymon, right? Strymon is the second subsidiary who is not paying dividend. He produces specialized components solely for Magnolia, right? Magnolia is the second subsidiary. So the third subsidiary is producing for the second subsidiary is producing for the first subsidiary of Lamri to assemble into finished goods. Strymon will produce 300,000 specialized components at 12 variable cost per unit. So that means for Strymon, the variable cost will be 300 into 12 for Strymon, and will incur fixed cost of 2.1 million for the coming year. So fixed cost is 2.1 million for Strymon. It will then transfer the component to Magnolia at full cost. Remember, it will transfer the component at full cost price. What is the full cost price? Your fixed plus variable cost, right? To Magnolia, where they'll be assembled at a cost of 8 per unit. So that means for Magnolia, the fixed variable cost will be 8 per unit, and they'll be sold for 50 per unit. So the selling price also 50 per unit. Unit has been given as 300,000. Magnolia will incur additional fixed cost of 1.5 million in the assembly process. So for Magnolia, the fixed cost is 1.5 million. Now, the proposal comes from here. Till here, it's fine, right? You'll be able to do. Now, they are going to change this proposal. Which proposal? Here you can see that the transfer prices, they are taking full cost price. Now they are going to change that. Tax Ethic is a charitable organization devoted to reducing tax avoidance schemes by companies operating in poor countries around the world. So they have petitioned Lamri's board of directors to reconsider Strymon's policy of transferring goods at full cost. They suggest that the policy could be changed to cost plus 40 markup. So there, in the first scenario, they were taking full cost price. That is your fixed plus variable cost. Here, what they are doing is with that cost, they are adding a 40% markup. That is the change. That is the proposal they are doing, right? They're changing. So you have to do before change and after change, you have to calculate the dividend capacity. That's your job. So if Lamri changes the Strymon's policy, it is expected that Strymon would be asked to remain how much? See, currently Strymon is not giving any dividends, right? Remitting any dividends to Lamri. But under this proposal, this cost plus 40% markup they are saying is Strymon also will now charge 75% of his after-tax profit as dividends to Lamri. So these are some other information, right? Number one, Lamri's outstanding non-current liabilities of 35 million on which it pays interest at 8% per year. This has been given to you for a reason, because when you take profit before interest and tax, you need to deduct your interest. For that's why it's given the non-current liabilities and your interest. And is 30 million $1 issued equity capital which will not change for the coming year. Okay. Second, Lamri, Magnolia, and Strymon profits are taxed at 28%, 22%, 42% respectively. Right? They're charged at different rates. Withholding tax of 10% is deducted from any dividends remitted from Strymon. So this you have to know that withheld is deducted from Strymons. Third, the tax authorities where Lamri's base charge tax on profits made by subsidiary companies, but will give full credit for tax already paid by overseas subsidiaries. So you are having a credit here. And last one is all cost and revenues are in dollar equivalent amount and exchange rate fluctuations can be ignored. Why this is given to you is because they're dealing in multinational, they're dealing in different countries. Tax rate is different in different countries, right? They are also going to face an exchange rate risk is there, but here they are telling us to ignore it because this is not an exchange rate question, right? So now we have to calculate dividend capacity both before the proposal and after the proposal. And second, part B, we have to show the impact of it and what are the actions Lamri is going to take because of those impact. And part C is we are going to say how the tax authority, how they can prevent the transfer price manipulation. So make sure that you should know what transfer pricing and all the rules for transfer pricing, how to calculate transfer pricing, right? So let's go. Right, marking scheme has been given to you, but before we go to marking scheme, I will take you directly to the answer, right? Dividend capacity. So first, this is, please mark this, what is it? Before implementing the tax ethics proposal, that is, this is full cost price. Okay, this is the transfer price. So under this method, what is your operating profit? Your sales revenue currently now, right? You're not going to increase your sales by 20%, 21.2 into 80. It has been already increased by 20%. So it is 80 sales revenue. Out of that, 30% is your operating profit margin. So 30% of 80 will be your operating profit. Deduct your interest. I told you non-current liability is 35 billion. Interest is 8%. That's what they have given. So that you can deduct your interest. Then you deduct your tax. 28% is the tax of Lamri. Right? This is Lamri. Lamri is paying 28% tax. Deducted. Next, investment in working capital. So investment in working capital. They told that it is 15% of the increase in sales. So what was the increase in sales? Sales is 80. But this 80, right? It is the increased amount. You have to work on the increasing amount. That change. So what is the change in this 80? Right? When you take this 80, it is not 80 over 100. Sorry. It is not 80 over 100, it is 80 over 120 because that 20% increase is there. It is with that 20% increase that 80 is there. So you have to take divide it over 120 and multiply by 20 to find that increase portion. Right? So it is that's why it's 80 divided by 120 into 20. And 15% of that will be a working capital, which will be 2. Then you take investment in non-current assets. So investment in non-current assets is also same. Increase in sales. But it is on whenever you are shown the increased amount like this for sales, like here it is 80, already they have taken 20% of something. Let's say 20% of Y. We don't know the current year's sales. So 20%, but they told that the increase is 20%. So 20% from the current year. Let's say 20% of Y is 80, right? Whenever you are given this type of scenario, you have to give it like this. Let's say the change was 30%. So it will be 30 divided by 130 into 80, like that. Right? And on that 25% will be your investment in non-current assets. And then comes to investment in new project, which has been 4.5 million. Right? That's why it's 4.5 because these are in millions. And then, so all this are your cash flow from domestic activities. Please put this heading there. It's very important that you put appropriate headings for each. What is it? You have to label it. You have to label your number. So it is cash flow from domestic activities because till here all these are domestic activities. Now they are going to deal with dividend remittances from their subsidiaries. Okay, and this is before. This is not cost plus 40%. This is just full cost, right? So overseas subsidiaries dividend remittance. If you see it is working one, let's go to working one. And before we go to working one, most of you will have this doubt why we didn't add back the depreciation like we used to do it before, right? It is because, please read the tutorial note, there is no need to add back the depreciation to obtain the cash flow as the investment that amounts to the total depreciation charge will cancel out this calculation. The effect is therefore neutral, right? Each question is different. Each question you solve in AFM will be different than the other. Something will be different, one or two things. You will never get exact same question. So that's why you have to touch all the questions to get better and better, to know more and more insights, right? What are the ways a question could be asked? How much a question can be twisted, right? There are many different ways of asking a same question in from many different angle, and you should be able to solve. You should know all the various ways of a question being asked, right? So overseas we are going to go under working one, right? And it is 3.16. So the working is here, right? I have told you that here your main working is there, if you can see. So your workings always comes at the end. Your main answer should always be presented first in the exam. Please make sure, and your working should be at the end. So here if you see, this is working one. We are only focusing on this. Overseas subsidiaries, dividend remittances. Okay, so sales revenue is 15. How it is 15? Because the quantity is 300 multiplied by. Okay, we'll check. It is here. 300 multiplied by 15 by 50 because they told sold for 50. which is 15 million. Please make sure that it's million, right? These are in million. So that's why this is 15 for Magnolia. Magnolia is the one who is selling. Then comes to the variable cost, right? Variable cost, if you calculate for Magnolia, right? Let's go up. It will be how much? 8 into 300. 8 into 300. And for Strydom, it will be 12 into 300. Variable cost. And fixed cost, if you see, it is 1.5 for Magnolia and 2.1 for Strydom. So here you can see 1.5 fixed cost and 2.1 fixed cost, and here it is variable cost is 2.4 and 3.6. just now we have calculated, and this transfer cost you have to calculate. This and this will be same. How you will calculate? Because they have told that the transfer cost is their total cost. What is your total cost? Fixed cost plus variable cost. What is your fixed cost? 2.1. What is your variable cost? 3.6. What is your total cost? 5.7. So this 5.7 is your total cost, right? And also it will be your sales revenue, right? So this is your sales revenue for Strydom, because Strydom is selling, but for Magnolia it will be a cost. That's why it's deducted, and you are getting here nil if you see, because your sales revenue is equal to your total cost for Strydom, so it will be nil. But when you come to Magnolia, you are having an operating profit. On that you have to take tax. How many percentage? 28%. And on that you are getting 4.21, and from this 4.21, 75% of this 4.21 is your dividend, which is going to be remitted. So the retained is 1.05. So this much 3.16 is going to be remitted to Lamri. So that's this 3.16 is here, if you see this one, right, which is here in working one. So all this working you are not going to show in this main table, this answer you are going to show in your working as a separate working. Now because of this profit, right, and Magnolia, we have been told that if a subsidiary company makes a profit, parent company have to pay tax on that as well. So less tax paid on Magnolia's profit. How much Magnolia is paying tax? 22%, but Lamprey is paying 28%. So the additional tax has to be paid, because in Magnolia less tax is being paid. So Lamprey has to pay additional 6% on 5.4 million. What is this 5.4 million? That is operating profit of Magnolia. This 5.4 million they are talking about, the operating profit of Magnolia. So on this you have to pay 6% and deduct it, and this is your dividend capacity 8.27. Now let's go after implementing the proposal, what happens. So if you see, right, most of you will do this mistake. You will go and start doing all this operating profit, less interest, tax, profit after tax, all these things. No need, because no matter what happens to your transfer pricing, your this will remain same. Cash flow from domestic activities 5.43 will remain same only. Nothing will change in your domestic activities. So exactly you can take the same figure here, 5.43. It will not change. All the things which we'll see, they told also see above. So don't waste your time. These are the things you need to know, how to save time. Don't go and start calculating it again. Some things which has been already been calculated, you have to know how to use it and proceed ahead. Here if you see, there are so many steps, so many workings are there, but here when you come, it's just 4 lines. So now we are going to only the overseas part will change. So overseas subsidiaries dividend remittance is working 2 now. Now let's go to working 2. Right, now if you go to working 2, sales will remain same, variable cost will remain same. Here also variable cost will remain same, fixed cost will remain same. Only thing which will change is what? Your this and this transfer cost, right? For Strymon is the sales, for Magnolia is the cost. How are you getting it? See, before how much was it? Your transfer cost was 5.7. So on this 5.7, right, this is your cost. Now you add 40%, which is 7.98. That's how you are getting the transfer cost. So this time you are getting a operating profit here as well. because it is not, your sale is more than your fixed cost and variable cost. And when you deduct here also, you are getting a revenue. So on this operating profit of Magnolia, you have to pay 6% tax. That's what you're paying here. 6% of 3.12 and deduct it. Right? Now let's go to working 2. Working 2 is not over yet. So from this operating profit, you deduct tax. How much tax? How much tax? Here it is 22%. Here it is 42%. Strymon is paying a higher tax, right? After that, you are emitting how much? 75%, and you are emitting 75% here. But guys, one thing you have to notice here, if you take 75% off 1.32, you will be getting 0.99, right? And you see that here it is 0.89. Why is that? The difference is because 10% withholding tax will be deducted from your dividend. The dividend which you are going to remit, that remittance, 10% withholding tax they will deduct. So from this 0.99, they are deducting this withholding tax 0.1. That's why the 0.1 is deducted and you have been shown as 0.89. Right? Because 0.199 minus 0.99 minus 0.1, which will be 0.89. So your remittance will be 0.89 and your withholding tax 10%, so it will be 0.1. It will be deducted, right? So when you take the total amount to remittance, it will be from Magnolia 1.82 and from Strymon it will be 0.89. Add both, you should get 2.71, right? 2.71. Add it. Right? And now there's a question that why you are paying additional tax on Magnolia profit. What about the Strymon's profit? Then you have to see the tax rate of Strymon and Lamri. See, Lamri is paying tax at what percent? 28%. But Strymon is paying at 42%. How can you get a tax credit? How can you pay additional tax in Lamri? You are already paying a higher tax in Strymon, right? So only that tax credit you are getting for Magnolia, not for Strymon. That's why you're only paying 6% additional tax for Magnolia's profit and not for Strymon's profit. And if you see the dividend capacity, here it was 8.27, here it is 7.95. It reduced. So now we have done the working. We just have to comment on the impact of the proposal. So let's read. If the proposal is implemented, Lamri's dividend capacity will fall from 8.27 to 7.95 million. We saw. Where's the dividend capacity prior to the implementation of the proposal? That means before this proposal exists the dividend to be paid, right? So they are saying that before implementing this proposal, that means this dividend, it was more than the dividend to be paid. How? Right? We have been told that the current dividend is 7.5 and 8% it will grow annually. So, and this is 8.1. So you see, dividend to be paid is 8.1, but your dividend capacity before the proposal was 8.27, which is good. But now it has reduced to 7.95, which is less than dividend paid, which is not good. So that's why they are saying that the proposal would lead to a shortfall in dividend capacity. Right? See, even if you have to comment also, some calculations you have to do. You have to show that change or some percentage. You have to show some numbers. You cannot, ignore it completely and just see the word comment and write only sentences and no numbers, no calculations. You have to do. Have this habit of using your numbers, doing additional calculations in your comments. The shortfall arises. Why? Okay, now they are saying the shortfall is there, but why is this shortfall? Shortfall arises due to high tax rate paid on Strymon's profit that Lamri cannot obtain credit for. Just now I told you, Strymon is paying 42% tax, whereas Lamri is just paying 28%. How can he get the credit? He cannot obtain that tax credit. That's why that shortfall in dividend capacity. Not only does Lamri lose the withholding tax, see, withholding tax also he's losing 10% he has to pay on that remittance. It is also paying an additional 14% in corporation tax. If you see 42 minus 28, see these are additional working. If you see, these are additional working, nothing else. This haven't been shown in your part A, right? So additional 14% corporation tax they are paying. They are losing withholding tax also. Also, their dividend paid is now less than their more than their dividend capacity. So all these are not good, right? Now let's see. We have been told in the requirement that we also have to give actions what Lamri should do. We know the impact, it's not a good impact, but what now Lamri should do as a result, we should say that as well. Okay, so there are several ways in which the problem of this relatively small shortfall could be overcome. We see that the change from 8.27 to 7.95 is not so big, it's a small shortfall, but how it can be overcome we'll see. Lamri might consider reducing the growth rate of its dividend, right? Reducing the growth rate of its dividends. What is the current growth rate of dividend? 8%. So Lamri can reduce it to less than 8% so that the dividend paid and dividend capacity is in line to a level that would be covered by the dividend capacity of 7.95 million, right? However, this might send, okay, see, you are saying that, okay, reduce the growth rate, but there's a negative, not a good sign. However, this might send adverse signals to the market given that a steady 8% growth has been maintained over the last few years. So the market perceives that, see, in the past, there's a steady 8% growth. Now, what happened that that growth rate reduced less than 8%, right? So they will worry. They will be, it's an adverse signal. They will not react positively to this. So you have to think from all this perspective. Just if you say an action also, you have to talk about its disadvantage as well. What could be the limitation of it? Now let's go to the another alternative. Just don't answer one. You are getting 3 to 4 marks for giving different types of actions. Right? Another alternative would be to borrow the shortfall. You can borrow. This may not be a popular option if Lamri wishes to avoid increasing his borrowing. See, if Lamri wants to avoid his finance cost, if he does not want to pay interest cost, he wants to avoid increase in borrowing because gearing will increase, then all risk will increase and all those blah blah. So in that case, this is not a popular option, right? You might say, right? You might argue with me that if this is not a popular option, then why are we writing this answer? Why are we giving this kind of actions? That is because you need to write an action, even if it's popular, even if it will be accepted by the company or not, still you have to give the recommendation. You have to talk about its disadvantage and advantage. You have to give some and talk about its disadvantage, right? Even if it might not be a popular, but still you have to. So this may not be popular action if they wish to, okay? Particularly to fund dividend payment, given that it would have to borrow. Okay, so now first they told that there's a disadvantage of going for a fund borrowing. If they want to avoid increasing borrowing, they will not go for this option. But what if they go for this option, right? Given that it would have to borrow to fund the current shortfall, there's a possibility that this problem would continue in the future. How? Leading to even greater borrowings or the potential of having to reduce dividend growth. Next paragraph. See, each paragraph, 1, 2, 3, 4, they are given different actions, right? One action in one paragraph. This is how you have to develop your answer. When you write answers also, when you give points also, 1 point per paragraph. If you're having 5 points, it will be in 5 different paragraphs. So your line, the way you explain does not matter. You can explain in 5 lines, you can even explain in 1 line also. You will get the same marks only, provided that you write to the point, right? Now let's go to the third one. Lamri might wish to consider postponing the project to a later date, but the potential impact on the company business would have to be evaluated. We are told in the scenario that a number of projects are in pipeline for the future, right? So therefore, postponing a current investment may not be feasible without impacting on future investments. So if you are postponing a current investment, it is not only having an impact in current, but it will also have an impact in your future investment. It is not possible that if you don't invest today, it will not have an impact in your future investment. It will have. So this method is also not feasible, right? So basically, the method of answering this type of question is they're saying all the possible actions which the candidate could think. So they are also saying that this might not be possible, or this is not popular, and finally they are coming to a point where they're saying, okay, this can be applied. So that's what they're saying in the last paragraph. The final possibility would be to ask for a higher remittance from Strymon or Magnolia. They can ask for the subsidiaries for the higher remittance. What happens because of this? The main problem with this would be the potential negative impact on the moral of the subsidiaries. Managers, if they are required to pay over the greater proportion of their profits, if a subsidiary is paying right out of their profit, majority of it is paying, they are paying as a dividend to you, to the parent company, they are not left with anything. Can they be happy? Right? So it will reduce they will be demoralized. They are not having anything to retain, so they cannot invest. Ultimately, in the future, it's going to affect their profits and also maybe their remuneration and all those things. So you need to think like this. So which may affect any profit related benefits they may have, right? If they're having their remuneration linked to the profit of the company, this can affect. Finally, part C, we have to talk about how the tax authorities can prevent the manipulation from the transferring price. For this, you need to have a very good understanding, a good knowledge of transfer pricing. It is given in your textbook, so please go through all this. But anyway, we'll go through this. Okay. So the transfer price manipulation is said to occur where Lamri uses transfer pricing to avoid payment of taxes and tariffs or other controls that government of the whole country has put in place. The most common solution, okay, the tax authorities have adopted to reduce the probability of the transfer price manipulation is to develop the transfer pricing regulation as a part of the corporate income tax code. These regulations are generally based on the concept of the arm's length standard. See, when you talk about preventing transfer pricing or transfer pricing, anything like this, you need to mention this term arm's length transaction or arm's length standard. This term has to be there in your transfer pricing answer. Without this, your answer is incomplete. Which states that all intra-firm activities of Lamre should be priced as if they took place between unrelated parties acting at arm's length in a competitive market. Even though it's a transaction, it is an intra-group transaction, right? You have to treat it as it is a transaction between two unrelated parties. How we deal with the open market, right? We put a price, we negotiate. So it should be like that. Even though in reality it is an intra-group transfer, right? Within the organization, within the group, right? It's not to an outside party where we have a competitive market where we know the prices. So you have to, that is known as arm's length standard. Okay, so arm's length standard is defined as the prices which would have been agreed upon between unrelated parties engaged in the same or the similar transactions under the same or similar conditions in the open market. In the absence of the existence of data to allow for reasonable estimate of the arm's length standard, then the alternative method is to establish the arm's length transfer price could be made. See, if you are not having enough data to make a reasonable estimate, okay, of the arm's length standard, what happens is you can use one of those four methods to establish a transfer price, arm's length transfer price, right? You have to go through all these four: comparable uncontrolled price, resale price method, cost plus method, and profit split method. You need to go through all this and you need to understand what all these four are in detail. Right here, they have given very briefly. So we'll also go comparable uncontrolled price. What is it? This method looks for a comparable product to the transaction in question being traded by Lamri in a comparable transaction with an unrelated party, or the same or the similar product being traded between two unrelated parties. So you can compare. There's a similarity. Maybe the product is same, right? Maybe the situation is same, but the part is unrelated. So you're comparing. Next, go to the resale price method. This method focuses on one side of the transaction, either the manufacturer or the distributor, to estimate the transfer price using a functional approach. So this is based from one side, the transfer price, from manufacturer or distributor. Cost plus method. This method starts with the cost of production, measured using recognized accounting principles, and then adds an appropriate markup over cost. The appropriate markup is estimated from those earned by similar manufacturers. It's not any markup, right? You cannot just put any markup as you wish. It should be estimated from those earned by similar manufacturers. Finally, the profit split method. This method allocates the profit earned on a transaction between related parties. Right? So these are some of the ways how they can prevent the manipulation of transfer pricing, the tax authorities, right, from happening. And now we'll go to the marking scheme, right? Part C, if you see, for the transfer pricing, it is for 5 marks, so 1 mark per valid point. Part B, right? So for commenting and explanation of the reason is 2 marks. Where is the action is 4 marks. If you see, action is 4 marks. So you cannot forget about the actions. Okay, one action is not enough. Now let's go to part A, because majority of your marks is here. So how this mark is distributed, you have to know. Before you sit for that AFM exam, you have to know how your marks are distributed. Just showing this 14 marks is not enough. How will you know how you are getting those 14 marks? Because if you don't know how you are getting the marks, you will not be able to work on those. So when you practice the questions from that day onwards, the first question you take, you have to have a habit of going to a marking scheme and seeing where the marks are allocated. That's how you learn, because it will be in your subconscious mind when you do such questions. What are the things I have to calculate? What are the things I need to work? Maybe it's not directly asked in the question, but I need to find indirectly. So that there is some link, right? That you need to find out, that you will get from the marking scheme. Reading answers you will not understand. If you read answers and try to memorize, it will not help you. But when you go through the marking scheme, first you read, try to attempt a question, do it by yourself, check yourself, your standard with the answers given, then go to the marking scheme, see how the marks are allocated, read the examiner's comment. That's how you learn. It takes a pretty good amount of time, right? You cannot rush through all the questions. If you're thinking that in a day I will do 10 questions, right? Yes, you can do 10 questions, but maybe you're just going through the answers. You're not writing it by yourself. You're not actually checking yourself. You're not actually going through the marking scheme, how the marks are allocated. Then that's a very bad strategy. You do 2 questions per day, it's fine, but do it properly. Take more time, do it correctly. Okay. So part A, first we have to calculate operating profit. So operating profit, interest and tax, 3 marks, right? Simple. It is easy to calculate operating profit because percentage of based on sales, and interest is also given, your non-current liabilities and your interest, and tax is given to you. So this 3 things is easy for you. This has to be your first opening starting point. Second, calculation of investment in working capital and non-current assets, including correct treatment of depreciation. Here in this question, you cannot add depreciation because you are doing investment which is equal to a depreciation, right? There has been a tutorial note also where we have read that if we add back the depreciation, the effect will be neutral, right? So calculation of investment in working capital and non-current assets is 3 marks. Here it is 3 marks because of that depreciation part. Second, calculation of dividend remittance before new policy implementation. So before, it is 2 marks. After, right, it is 3 marks. Now, calculation of additional tax payable on Magnolia profits before the new process. So additional tax itself, right, that additional tax you are getting 1 mark. Even after the new policy, again additional tax 1 mark. And finally, dividend capacity is only 1 mark. So you see, your workings, most of your workings marks lies in your workings, in your steps. So even if your dividend capacity is wrong, don't panic, don't feel bad that you are losing marks, you are going to fail and all, because it's just 1 mark you are losing, but you are getting other 13 marks. So that's how. So this is, with this I have ended all the 10 questions under your first section A, that is role of senior financial advisor. Next, I'll be covering the other topics, right? Other 4 sections. So meanwhile, don't forget to subscribe to my channel. If you haven't subscribed to my channel, do subscribe, right? You have tons of videos to watch, and it's a great opportunity for you to sit back and learn AFM by yourself. You don't need any tutor, you don't need anyone. You can just see the videos and just attempt the questions, and that's it. So do subscribe and don't forget to take care of yourself too. Best of luck.